My dad always called me Jake as a kid, and so I literally am Jake from State Farm. And I do have khakis, and my voice is hideous. Of course, I'm a guy, right? Okay. I guess y'all seen the commercial, right? All right, cool. I do not stay up till 3 in the morning taking quotes, though. I let other people do that. Thank y'all for letting me be here. I was just watching you guys as I was getting ready, and it reminded me, it's been 32 years since I graduated college, and everything looks about the same, but except for the little things that you're looking at, and you're doing this and this, right? I didn't have those when I was in school. We still had notebooks and pencils, and that's about the only difference I've seen. Kara asked me to talk to you guys a little bit about insurance, and that's kind of what I do. I'm an agent, which basically means I represent a company, and I offer products to consumers. State Farm is, everybody probably has heard of State Farm. We're the largest insurance company in the United States. Been around since 1922. Interestingly, they started out as a company that really insured farmers. That's why they called it State Farm. They noticed that insurance policies were primarily for people in the city, okay, because that's where you had the most activity back in the early 20s. And there was a guy named J.G. Mahurl, and he was a innovator, and he wanted to offer coverage for people as they drove their motor vehicles out in the rural areas, in the farmlands, and that's why State Farm was created in 1922. And of course, they've grown. They started doing homeowners later, and then started doing life and all that. And now they're pretty large, and they do everything basically, which is what I do. I do auto, I do life, I do health, I do mutual funds, and so we even do banking. State Farm Bank is a little bit differently. It's more of a virtual bank where you can actually go in and you can't bring me money into my office like a depository branch, like at a bank branch. But other than that, I can do about everything else. Apply for credit cards, do mortgages, et cetera. So it's really interesting to watch how the insurance business has changed over the last 30 years, because now you have to be pretty much all things to all people. Does that make sense? It's all about convenience, okay? If a consumer doesn't get the convenience they want, then they'll go somewhere else, right? And that's part of the society we live in, which is not bad. It just means you've got to wear a lot of different hats, okay? So anyway, thought what I would do is kind of just go over types of insurance. We're all familiar with auto insurance. If you're at least 16 years of age, I'm sure you are, you know what that's about. But I wanted to get into it a little bit to help you understand a little bit about why you have what you have. I think that's one thing that I run into all the time, that people just don't really understand what it's meant to do, okay? They know I got to have it because the state mandates it, but what is it really doing? Okay, that's kind of the key thing. And we'll talk about the other types as well. Just a little bit about my background. I went to college, and I went to Campbell University in North Carolina. Grew up around Southern Pines as a kid, and I was a trust major. What's that? Well, trust is like a trust in estates, okay, estate planning and that kind of thing. And my first job was at Piedmont Trust Bank, which is here in Martinsville, which is now BB&T, and I worked with estates and wills and people's investments and stuff like that. And I did all that for about 10 years. And then I got out of the business. Trust banking changed a lot. Then I got into the insurance business, and I primarily did life insurance. And I moved to Richmond. I was there about 7 years. And I moved back here in '97, and I've been here 12 years as an agent with State Farm. I started in May of '01. Anyway, but it's fun. The neat thing I like about the insurance business is you work with people. I hear that all the time. I'm a people person. Well, you better be a people person if you're a State Farm agent, because you're talking with them all the time, okay? Their needs, their wants, their concerns, their goals, their dreams, their visions, okay? Because when you really get right down to it, that's what insurance is all about. It's about protecting your goals and your dreams, okay? The life you envision, okay? You protect things. I don't know if you've ever heard of the word indemnify, but indemnification, or the word indemnify, means that you're putting somebody back into the position they were before they had some event, okay? If it's a car accident, you want to be indemnified. You want to be restored to the pre-wreck status, right? So indemnify means to put back or to get you back where you were, okay? So speaking about auto, let's go there. How many of y'all have ever heard the phrase 25, 50, 20? Does that mean anything to you? Okay. Well, all that means is the state of Virginia has liability limits, and they're $25,000 per person, $50,000 per accident, and $20,000 for property damage. And they're shortened to 25, 50, 20. Those are the liability limits, okay? Liability means if you're driving your car and you're negligent, i.e. you're stupid, and you do something that's kind of like dumb, and you hurt somebody else or damage another person's car, liability is what that means, okay? We, State Farm, are going to come in and protect you up to $25,000 per person, $50,000 for all the people in the accident, and $20,000 for the property damage you may incur. That could be in the form of damage to another car, damage to a tree that you hit, damage to a house that you hit, or a building, or whatever, okay? So those limits that's the minimum. Now, if you've got those minimums, you might want to talk to your current agent and just see about upping those, because really when you get right down to it, those limits are to protect you in case you are negligent, okay? And you don't mean to be, but you just are sometimes. You're in a hurry, you're not thinking, you might be texting while you're driving. Of course, I know none of you would ever do that, right? So that's what it's all about, though. You're protecting. So it's pretty interesting. It's not really that much more expensive to go from 25, 50, 20 state minimums to maybe 50, 150, or at least what I would recommend as 100, 300, 100. Those are better, okay? It's just protecting more of your assets, okay? And what do I mean by that? Well, maybe you own a house, or maybe you got cash value in a life insurance policy, or you've got savings built up, or whatever, okay? People that, when you go into court and you're negligent, the court can attach your assets. So that's why it's important to look at those limits being higher. Insurance is about protecting what you own, right? Putting you back into the status you were before you had the accident. So it's pretty important to look at that. What are some of the other things on a policy? MedPay. You probably have MedPay on your policy. It's optional. It's not required. But that basically is an additional amount, maybe $1,000 or $2,000 or $5,000. You can even go as high as $25,000. But it's basically to cover any kind of injuries you have in an accident. Okay, and the people that are with you. Okay, riders that are along with you, maybe your children or just a friend. Okay. MedPay is also interesting in the standpoint that you don't have to be in a car to get it. Okay, let's say you're an auto insured person and you're on this sidewalk uptown Martinsville and you step off the sidewalk and the car brushes by the corner and knocks you down and you have a broken bone or something like that. MedPay will pay in that event. Okay, if you're killed in an automobile accident, MedPay turns into a death benefit. So it's good to have some of that. Again, it's optional, but it's not a bad thing to have, and it's really not that expensive. Okay. The two main physical damage coverages that you have on an auto are either comprehensive or collision. Okay. Now, unless you own your car straight out, no loan, you're going to have comp and collision. Why? Because the lender is going to demand that you have it, right? The lien holder. Okay. They typically are going to want to have at least a $500 deductible on comp or $500 on collision. What's the difference? I have that question asked all the time. Well, and I'll explain more what I mean by this, but comp is anything that's not collision. Duh, right? Sounds right. But it means, well, let's take collision, for example. Collision is anything that, let's say you're driving and you strike somebody or a tree or something. Collision is the actual event that happens when you run into something with your vehicle, and it's your fault. If you are hit by somebody and it's the other person's fault, well, you're going to file on their policy anyway, right? So your policy won't come into play there. But the comp, the other side of that comprehensive is really anything that's not collision. It could be a deer striking you, okay, coming out of the side, and you see it peripheral, and it hits you, and there's nothing you can do, it just hits you. Hail damage, a tree falling down on your car, a dashboard fire. Let's say you have an electrical fire inside your dashboard, burns your whole car up. That's comprehensive as well. Okay, so I'm trying to think. Theft is comprehensive. Okay, so The deductibles that you'll see are obviously what you're going to have to pay of that event in terms of the damage. So if you got a $500 deductible on comp, and the whole damage is $600, you might want to consider not even filing it. Okay, it's not worth it because you got to pay $5 of the $600. But if it's $2,500, yeah, go ahead and file it. Comprehensive doesn't typically hurt you in terms of your insurance record, I guess is a good way of putting it. They don't look at it as being an at fault. The collision claims, they do, and you'll eventually have higher rates if you keep having accidents. Just hope that your company doesn't cancel you if you've had too many. So, is that comp and collision kind of clear, basically? I always tell people when it comes to deer, if you don't have collision and you have comp and you swerve to miss that deer, and you hurt your car, you damage your car, you don't really have any coverage. And the reason, can anybody guess why? Right. The main thing I said, though, was you didn't hit the deer. So I kind of kiddingly tell people, turn around and go find the deer and run him down. Okay? Get some hair in your, deer hair in your front of your car. Of course, I'm kidding, but it just serves a good point. If you see an animal, I know instinctively you're going to want to swerve to miss it because we all love animals, right? However, statistics show that if you'll go ahead and hit it and not swerve and flip your car and maybe kill yourself, okay, it's better to go ahead and just run over these animals and try to get it done through that. You usually protect your own life better, and but I know that's hard to do because instinctively you want to try to miss it, okay? So unless you hit it, it's going to be comp, but if you don't, it's going to fall into a collision claim. So let's say you have a $100 deductible on comp and $1,000 on collision, and you swerve to miss the deer, and you end up flipping your car. The damage to your car is going to be subject to a $1,000 deductible as opposed to that $100. Okay, so you kind of got to look at the event, what really happened, right? So that's a little bit about auto coverages. The other things on auto that are kind of standard is uninsured motorist. That's part of your liability, okay? And you typically automatically have that just because you've got the car. But that's good because let's say somebody hits you and then they just run off. That's where that coverage is going to come into play. Or they hit you and they have no coverage, okay? Or they hit you, they have coverage, but they don't bother to tell you who they are. They don't leave a note. Well, you're going to have to pay the deductible, and it's probably going to be $250 or $500, and then your car will get fixed. The insurance companies don't hold that against you if you had nothing to do with it. Okay, so whether you're at fault or not is a big issue. Okay, so when you have a situation like that, try to get witnesses. Okay, that's very helpful. And the other thing too, if you let's say you have an accident in Walmart, you got to remember that's on private property, right? So having a witness is very important there. But also don't forget they have security cameras there. So go in and talk to the manager and say, hey, can I get the tape for this? I might need it for insurance purposes. Not a bad idea. Okay. Okay. Homeowners insurance. Obviously, it's there to protect your home. One thing that I find a lot that's common is that people will have it, but they don't really know the amount they have. Is it right? And what I mean by that is, will it rebuild the house at what it would cost to rebuild it? I get calls a lot of times from people, and they'll say, you got my house at $200,000. I couldn't get $200,000 if I tried to sell it. Well, you're talking about a totally different scenario there. We're not trying to do that. That's called fair market value. That's just a figure between a willing buyer and a willing seller. What we're doing, what we're paid to do, is rebuild your house at what it costs today to rebuild it, not some old value. So really, it's always a better idea to make sure you're, and the phrase for that is replacement cost. You want to make sure your replacement cost is right. Okay? And a lot of people are underinsured because of that. So if you have a home and you haven't looked at it in a long time, if it doesn't have some kind of protection in there to make sure it keeps up with inflation, you might want to revisit that with your agent. Okay? Typically not that expensive to do it. Deductibles on homeowners, I've seen over the years, really have now started to go up a lot. And that's really not a bad thing. I wasn't in the insurance business when this was happening, but you would see homeowners deductibles like $100. Well, what many people would do, not everybody, but many, they would start filing claims for a gutter falling off, or just maintenance type stuff. What that does to the insurance companies, it drives up the cost, because we find that what we end up doing, the policy ends up working like a maintenance policy, and it was never intended to do that. Okay, and a real homeowner's policy, it's really intended to recover from the big stuff. Okay, fires, tree falling on your house, explosion, whatever. Also, by the way, unless you have a flood policy, heavy rains coming into your house, that is not covered. Right? That's not really a standard. It's not designed to be what they call a peril, P-E-R-I-L. A peril is anything that causes damage to your home. So just remember that. If you're considering, if you think that could happen to you based on the elevation of your house or whatever, consider getting a flood policy separately. A lot of times they're not required unless you live in what they call a floodplain. But flood is kind of a big issue now. Another thing that's not covered is mold. Okay, if you've got a wet situation in your house, the insurance companies are going to expect you to take care of that yourself. I'll give you a good example. Let's say you got a commode that's leaking. Have you ever been using the bathroom and you get up from the commode and all of a sudden the floor's like, it's weak? Okay, well that is not a good sign, because there's probably some kind of leak under that flooring. Okay, and if that happens, there's a good chance with water staying in an area, mold will develop. And when mold develops, and you try to file that as a claim on your homeowners, they're going to say denied. So when you've got a situation like that, try to get to it, be proactive, fix kind of things like that, okay, that you can. That falls under the maintenance type situation. Don't just say, oh, I got a weak floor and I'm going to file a claim. You're probably not going to get a positive answer there. Okay? So homeowners is not intended to take care of every little thing that might go wrong. It's for the big stuff. And so going back to my original point, you're going to see deductibles higher and higher nowadays. 1,000, 2,000. Now they have what is called percentage deductibles. It could be 1%, 2%, 3%. Or 1%, 2%, 3% of what? Well, of the dwelling, of the house amount. So if you got $180,000 on your house and you have a 1% deductible, your deductible is $1,800. Right? So, but the higher you go up in deductible, the lower the cost of the insurance. Just remember that. And it works opposite. If you want to drop your deductible, your price is going up. Okay? Any questions on that? That's kind of a quick overview of homeowners, but it's good to have. Another thing that's really good for you guys if you're renting is to get renter's insurance. Okay? And maybe you haven't even thought about that, but renter's is something that you need to cover your contents. Obviously, if you're in a house or an apartment and you're renting it, you don't own that place. Okay? But renters will cover all your TV, your computer, your furniture, your plates, your bed, your pictures, all that. Okay, that's really cheap insurance. I think our minimum policy on a renters is $20,000 of content. That will probably cost you between $8 and $11 a month. It's worth it. And typically, if you'll take your renters and let's say you go where your auto insurance is. If you get that renters through them, the discount that you get now on your auto for having 2 lines of insurance will typically pay for the renters and almost make it free. So you have no excuse really to not have it. It's good insurance. Okay. The other thing it does, and people don't think about this usually, is not only is it covering the contents that you own in that apartment, but it's got liability on it. Remember we talked about auto liability? If you're negligent and get sued, that's where we come into play for you. Well, let's say you're in your apartment and you're cooking fish and you have a grease fire, okay? And all of a sudden there's flames and you don't know what to do and you're throwing water on it and that's bad and you don't know what to put the fire out with and all of a sudden it burns half of your apartment down, or not all of it, but really a lot of damage. They got to repaint the walls, they got to get the smoke smell out and you're out, blah, blah, blah. Your landlord is probably not going to be real happy with you, right? Because obviously you're the one that started the fire, and even though you didn't plan to, and they could sue you. Well, liability is also on our renter's policy, so it protects you. Right? So that's a good thing to have there in case that did happen. And believe me, for just a few dollars a month, it is worth it. Okay, so renters is good. If you own a house and you're renting it to somebody, that's called a rental dwelling policy. Kind of like a homeowner's, but it's similar to that. It protects the house that you own that you're renting out. Okay. There's also policies for your jewelry, for maybe a real expensive violin. They call those personal articles policies. Shoot, you can even get those for a nice set of golf clubs that you don't want to have lost, or if they're stolen, you can get them replaced. I've had a set of golf clubs stolen before. So anyway, those are kinds of things. You can insure those. Really expensive watches or anything really. Guitars, whatever, okay? The nice thing about those kind of policies, they do have some coverage under the homeowners, but it's limited. They only pay so much. These personal articles policies, they're what we call an all-risk policy, meaning if you just have them stolen, or let's say water comes down from the ceiling and it just ruins that item, that'll be covered under those. And they're really not that expensive. They're pretty cheap. So just trying to make you aware of some things that maybe you hadn't thought about. As far as health insurance goes, obviously, how many guys are on their parents' policies still? Okay. If you are, you typically can remain on that through December 31 of the year that you turn 26. Okay? If that's coming up soon and you don't have a job, you're probably going to need to go get an individual policy. Now, as you all know, there's a ton of stuff going on in the news about health care. I don't know a lot about what to tell you there because it's so new. But if you do want an individual policy, you can get those still. But if you choose not to, then of course through the Affordable Care Act, there's all these penalties, which is basically a tax that you can pay. Health insurance, really, when you get right down to it, it's protecting what you own. Okay, because if you have a huge claim and you come down with cancer, and if you don't want to be one of these folks that you go into the store and you see your picture on the glass jar and they're asking for donations to help pay for the bills, which will probably never be able to be paid, you can really lose everything you own. Okay, and that's why health insurance is important. So health insurance is big. Again, you don't have to pay for everything there. You can choose your deductible being higher to make your premium lower. I would suggest if you have to pay for it yourself, consider looking into what is called a health savings account, or an HSA. Basically, it's a way of paying for your premium with pre-tax dollars. It saves you a little bit of money, and there's no cost typically to have those HSAs set up. But again, it's about leveraging money. You're paying a little bit of premium for a lot of coverage, and that's why people typically want it and need it. Okay, because why? Because they can't self-insure. You can self-insure on all this if you have enough money. But who among us has all that much money, to do that? That's why you need insurance. You're spreading the risk. Okay, you're paying somebody a little to protect if something a lot happens. Life insurance is probably the thing that I can talk to you about till tomorrow at this time. Oh, there's my watch. Life insurance. I love life insurance. To me, these other things, auto, home, health, they're all very, very important, and don't get me wrong, I'm not discounting them, but they are all where things happen to you that you can recover from. Does that make sense? Life insurance is different. Life insurance is about love. Okay, if you let's say you want to buy a life insurance policy on somebody, if you don't love that person, there's no need to buy that policy. Okay, because life insurance is about making sure the dreams and the visions and the goals that you might have, or maybe another person has, are realized in spite of a premature death. Okay, does that make sense? It's different because we can't do anything about the actual loss of the person that passed away. Okay, but what we can do is to make sure that when that happens, and that is another way of looking at it, when, not if, but when that happens, that you don't have to suffer the emotional and the mental anguish of not being able to afford not only to bury the person, but to maybe take care of the things that that person was going to need to take care of because, for example, let's say they had children, okay? And let's say they got children 4, 2, and 6 months. Well, those children are probably going to need to go to college one day. Life insurance is a great way of taking just a little bit of money and making sure that if and when something does happen to you prior to them going to school, hey, the money's there, okay? You can keep dreams realized and fresh and possible through life insurance. That's the only product that really does that. Okay, sure, you can take money and start investing it and saving it in mutual funds maybe, but you don't get the same effect there because there you need time on your side. It takes time to build up $200,000 in an investment, and many of us don't have that when it comes to what happens if we die prematurely because we don't know when we're going to die. Statistically, you're going to die when you're 75 to 85. Okay. That's what we call actuarially, or actuaries are people that work for insurance companies that I call them eggheads. They're sitting there thinking, okay, you know, whatever, and they're kind of geeky. But their numbers are accurate. They know, okay, what's going to happen and when. That's theoretically. But in real life, you don't know when you're going to die, okay? It's interesting. Let's talk about the types of life insurance, too. Really, there's two kinds. There's the kind you rent, there's the kind you own. Okay, you're probably still sitting there thinking, what are you talking about? The kind you rent is what we call term insurance. Okay, term is good in one way, but bad in many other ways. Term is cheap. Okay, term is paying for the pure cost of the coverage. Okay, and these actuaries that I mentioned, they know statistically when you're going to die. Okay, and because of that, when you start out, it's very, very cheap. You can buy, as you've seen probably the commercials on TV, $300,000 for $16 a month. Well, that's a really good rate, but very few people can get that rate because you've got to be in super, really good health. Okay, but here's the thing about term. The old saying is, term is actuarially designed to lapse right before you do. Okay, kind of humorous, but also very, very true, because they know that when you buy that policy, as you get older, think of your life expectancy as a window that is over the kitchen sink, and the sun is setting through that window. As you're getting older, that window is shutting. Okay, you're running out of years. Well, as you're running out of years, guess what happens to the cost of you being insured? It's doing this. Okay, let me ask it another way. What percentage of all term life insurance do you think ever pays a death benefit? And that's not just individually owned term policies, but I'm talking about your group term that you get through your company. Okay, what percent do you think actually pays a death benefit? 5%. How much? 5%? Okay, what else? Anybody want to guess? 2%. It's closer. The answer is 3%. Now, is term bad? No. It will pay if you die during that term. But statistically, you're not going to. Statistically, you're going to die 75, 85 to 90. People are living longer, right? Now, if you did die at 40 and you still had another 15 years on that term, yeah, it's going to pay. But this is kind of crude, and I'll go ahead and say it anyway, but it makes a good point. Term is kind of like peeing in your pants. It gives you a nice warm feeling initially, but eventually you got to do something about it. Okay? Right? Hopefully you remember that. All right, good. But it is. It's cheap and it's good. However, the likelihood of it ever paying is not going to happen. So the other kind is what we call permanent, the kind you own. Okay? And it traditionally has always been whole life, but in the early 80s, a company here in Virginia called Life of Virginia created something called a universal life. And going back to the whole life, it was always, it earned dividends. Okay? That's how it grew. There's something called a cash value. As that cash value grows, which it needs to, because as you get older, internally, not the premium you pay, but the cost of covering your life, it's doing that. Okay? It's getting higher and higher. So you've got to build this cash value as you get older. Well, dividends always did that, and it has real strong guarantees. Universal Life took a little bit different approach. They said, okay, we don't want to use dividends, we want to use an interest rate in terms of how it earns its cash. So it made it an interest-sensitive product. Well, I got in the business in March of '91. fixed rates on Universal were 14.75 then. Now they're like 3. Okay, so they've really dropped. And what you want to do as an agent, you don't want to sell the product on the assumption, because that's all you're doing is you're assuming, you're projecting out into the future. You don't want to assume that you're going to always average 14.75, because if you did, you're going to have some big problems. You're going to have a lot of angry customers. Because what you did, you said, okay, I'm going to project it will always average 14, and because of that, we only need this much premium. Well, if you never visited with that customer over the last 17 years, they're going to probably get a letter saying, hey, you need to really increase your premium, or we need to take that $200,000 policy and change it to a 25. Neither one of those are good options, are they? So you're going to be mad. So it's important whenever you buy a cash value policy that you communicate with your agent. Don't just buy it and stick it in a drawer and think, oh, I've got it. No. They're a living, breathing organism. You've got to look at them and address them in terms of, hey, am I putting enough in it? Is it growing the way I projected originally, way back in whenever? Okay? So they're good, though. That's the kind that when you die, you're going to own those. Trust me. Okay? If you keep continuing to meet with your agent every 2 or 3 years and check up on them. Okay? But those are really neat because you've got value in those. Remember how I said you can rent, which is term, or you can own? You've got value. Yes, you have a cost, which is higher. That's the negative of a cash value. But you're going to have something to show for it, too. When people die, that's the kind they typically own. Okay? It's very inexpensive to cover your children. If you have small kids, especially, up until they're 25, put them on there as a rider. I think we charge $400 to $450 a month for $10,000 on whether you have 1 child or 10. It's not a per child monthly rate. It's just a child rate. And that's really good. And you can do what they call convert those policies. You can change them over to their own individual policy between whatever age they are when they get on it and 25. Okay. One good thing about term that we hadn't talked about is if you buy it, and obviously let's say when you buy it you're very healthy, right? Well, let's fast forward 13 years. Now you've got diabetes, you're insulin dependent, and let's say you had a heart attack. And let's say what you bought originally was a 20-year term. That means that the premium and all that was guaranteed for the next 20 years to not change. Well, if I'm sitting there in the 13th year and my health has gone south, what do you think my prospects are in 7 years when that term policy comes up for renewal and I'm going to be facing not only being 7 years older, but now I'm unhealthy, right? What can I do with that term policy? It starts with a C. You can cancel, but that might not be the best thing. What I'm looking for is convert. You can convert that policy. So now what you can do in that 13th year, you can say, okay, I'm really unhealthy. I know I can't get new coverage. But I remember when I bought it, I was a preferred non-smoker. I was healthy, right? You can go to that agent and say, hey, I want to convert this to a cash value policy. Even though I'm 13 years older, I'm also going to be a healthy person, even though I'm not. Because they see you as a healthy on the day of issue 13 years ago, right? So now I can go in and convert as a preferred non-smoker if you're still... Now, if you're smoking, you're going to have to be a preferred smoker. That's something they can't control there. But anyway, that's a great way of protecting. So term has a good benefit there. So if your health goes south, really consider converting it. And even if it is higher, believe me, you'll pay it. Because otherwise you are uninsurable and you'll never have any life insurance. Okay? So I can talk about that all day, but that makes differences in people's lives. See what I'm saying? That's what I meant about do you love that person? Because you can recover from an automobile wreck. You can get fixed up and your car can get fixed up and you can rebuild a house. But you can't, if somebody dies and you're dependent on them, totally different. It's too late. Okay? Health, life, fire, auto. Can we think of any others that I didn't cover that y'all might have a question about? Yes.
What kind of businesses do State Farm cover? Like, I want to start a residential group home service. Does State Farm cover residential homes?
I can't answer that right this second because it's going to depend. There are businesses that are eligible and those that are not. Okay. And different companies will do it differently. But yeah, I know we can do like flower shops and We can do restaurants that don't have wait staff. In other words, if you just go up like a Subway, we can do those. There are certain risks that they just don't want to take on. But yeah, you call me, I'll be glad to see if I might be able to help you. Sure. Yes. I don't have any with me, but I'll be glad to write it out for you. I just didn't bring any. Sorry. But yeah, it's a really fun, but just from a personal standpoint, it is a really fun business to be in. It's not boring at all. Trust me, it is not. Technology has really made it fun because now, I mean, you can now go on, and actually starting Monday, you can do a life policy on your home computer and then choose me as your agent in this issue. I would have never dreamed of that 20 years ago. Okay? You can get your auto online. You just pick your agent. Okay? Why do they do that? Again, it goes back to what I said in the very beginning. You got to give the customer the options to do business when they want and where they want. If you don't give them that, see ya. I'll go to the Lizard or I'll go to Flow. You know, it's all about convenience. It's all about convenience. But here's what it really is about. It's about relationships. Yeah, I sell products, but that's really not the main thing we're doing. We've got a relationship. I'm very, very close with customers because I get to talk to them and I get to, just ask them about their life and their children and all that. And that's where an agent comes into play. You can't get that over the computer. Okay? So people want advice and they want to have some personal, they want to trust you. Okay? And if you're in the community and you're doing things and they see you, it's a win-win for you as an individual if you ever want to get into the business. It's a great way of not trying to make yourself look better, but it's a way of caring for your neighbor. Okay, and then literally that old phrase we have in our company, like a good neighbor, that's very true. And that phrase comes from caring for people and trying to help them in times. What are y'all smiling about?